I think what we're experiencing now is like a minor version of a crack up boom, for lack of a better way to describe it. It's basically that that I think fiscal dominance is probably the cleanest way to describe it, which is that when you have very high public debt levels and then you try to raise interest rates, and it blows out the deficit and is stimulatory when you want it to be restrictive, that's basically this cycle that's really hard to stop. And so, not like a crack up boom in like an emerging market or kind of the traditional sense is a lot more extreme. But in the kind of developed market context, that's kind of what we're experiencing right now, and that's not really happened in investors' timeframes, like investors' lifetimes in developed countries. It's primarily been an emerging market phenomenon or a phenomenon from war-torn countries ages past.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day. Fiscal dominance has emerged as a pivotal concept, particularly concerning its implications for market dynamics. At its core, fiscal dominance delineates a cyclical pattern wherein elevated levels of public debt pose significant hurdles to the effective adjustment of interest rates. This phenomenon often leads to a conundrum wherein monetary policymakers find themselves constrained in their ability to respond adequately to economic conditions due to the overpowering influence of fiscal considerations. Amidst the currents of contemporary markets, discernible echoes of a phenomenon reminiscent of a crack-up boom have begun to surface. While historically associated with emerging markets or nations grappling with the aftermath of conflict, this crack-up boom appears in a milder form across current market trends. Such manifestations underscore the fragility and intricacies of modern economic systems, hinting at underlying vulnerabilities that warrant careful scrutiny. Against this backdrop, Lyn Alden endeavors to provide insights into the macroeconomic landscape anticipated for 2024. Amidst the discourse, palpable concerns regarding the stability of the global financial system loom large. Her analysis serves as a clarion call, prompting stakeholders to confront the multifaceted challenges confronting the global economy with a sense of urgency and resolve.
For example, I think if you want to be in that bullish kind of tech area, I mean, I'm structurally bullish on Bitcoin still. Today it's been kind of bumping around 50,000, and there's kind of maybe some local excitement about it, but I don't think it's really widespread yet. And I have no particular view on what it does for the next 3 to 6 months, but I'm structurally bullish for multi-year view. For some kind of like lower volatility areas, I mean, I generally still find the energy complex pretty interesting. It's profitable in general. It's maybe the balance sheets are pretty good. It's not expensive, and so you basically have this like long-term positive carry exposure to the risk of higher energy prices in the future, and you get paid to wait. That's what I mean by positive carry. So I think that's a decent, kind of a different type of position. I find select emerging markets interesting. So Latin America, for example, certain parts of Southeast Asia, we could see a China equity market pivoting to some extent, but investors have to be somewhat careful about geopolitical issues like tail risks that could occur. Kind of like how if investors were exposed to Russia, the war happens, and then they basically get all their assets sanctioned, and the company is still there, just your claims of them are contested. So there's tail risks that things like that could happen to China. But basically, wherever capital's not heavily exposed to right now, but that still has decent fundamentals, I think are fairly interesting. I think that there's some of the kind of, if you look at, for example, the S&P 500, the normal one is market weight. There's an equal weight version, which sometimes
In mapping out investment strategies for the year 2024, it's crucial to consider various factors that shape the financial landscape. Here's a breakdown of key points to guide your investment decisions. 1. Bitcoin, navigating short-term volatility for long-term gain. Bitcoin continues to captivate investors with its long-term potential, despite enduring bouts of short-term price volatility. While its value may fluctuate in the near term, many investors view Bitcoin as a promising asset class due to its finite supply, decentralized nature, and increasing adoption among institutions and retail investors alike. Embracing a long-term perspective, while weathering short-term price fluctuations could yield substantial returns for savvy investors in the cryptocurrency space. 2. Energy markets, profitability and resilience amidst uncertainty. Amidst evolving global dynamics, energy markets emerge as compelling investment arenas for 2024. Companies within the energy sector demonstrate resilience, boasting strong balance sheets and profitability metrics. Moreover, the potential for future price increases underscores the attractiveness of investments in energy-related assets. By carefully assessing market trends and identifying companies with sustainable business models, investors can capitalize on the stability and growth opportunities inherent in the energy sector. 3. Emerging markets, unveiling opportunities amidst geopolitical caution. The allure of select emerging markets, particularly in regions such as Latin America and Southeast Asia, beckons investors seeking high-growth opportunities. These markets boast untapped potential, fueled by demographic shifts, urbanization, and expanding consumer markets. However, caution is warranted due to geopolitical risks inherent in these regions. Investors must conduct thorough due diligence and adopt a nuanced approach to navigate the complexities of emerging market investments, mitigating risks while leveraging growth prospects.
Performs and sometimes underperforms. If we do get a period of sustained economic reacceleration, then that equal weight one, which did way worse than the market weight one last year, could play a little bit of catch up. So there are many equities out there, either domestically or foreign, that are not that expensive, even as other ones are. There's kind of a bigger than normal valuation gap between different types of equities. And so that's kind of how I'm viewing it. When I want to take on volatility, my preferred way to express it is Bitcoin and certain other select equities. And when I want to be defensive, it's things like short duration T-bills, it's tips, it's gold, it's certain defensive sectors. We've already hit some of the targets. I have a very big range for what I expected to go to. I've been trying to stick to like a 2-year view because I don't really know for sure what's going to happen in 2024. I have higher conviction that throughout the course of 2024 and 2025, it'll be notably higher than it is now. That's kind of my overall base case. I'd be surprised if we didn't see 6 figures in that 2-year view. Certainly possible that we won't, but I'd be surprised if we would not. And from there's a very big range because you're basically you'd be trying to predict what do humans do when the price goes up. Well, how much of them will buy, I don't know. But basically, we know the supply side. We can also look at on-chain indicators to see, for example, the behaviors on the supply side. So you can look at how many coins are held by entities that have a very low propensity to sell. And during bear markets, that ratio goes up. The people that have been buying coins in the bear market, that have gone through a lot of that, they're really not going to sell anytime soon, even with a significant bull run. It would take a very high price point to get those coins out of their hands. On the other hand, when you have bull markets, you have a lot of new buyers coming in. Generally, that's the handful of times when those longer term holders tend to sell. They sell into that strength. We've not really seen that cycle start yet. And so I still think we're fairly early phase in the bull market. But that doesn't mean anything about 3 months or 6 months. Generally, my research shows that Bitcoin price is heavily correlated with liquidity in any given multi-month period, generally speaking. And so kind of the stuff we talked about earlier in the conversation, what happens when the reverse repo facility gets low? What are some of the liquidity actions that they can resort to? How bad would they let liquidity get before they were forced to intervene? Those types of things can all determine what Bitcoin does in a sort of given quarter or a couple quarters. But long term, next 2 years and longer, I'm quite bullish.
By analyzing on-chain data, investors can gain insights into the dynamics of the market and make informed decisions. 2 key points emerge from studying on-chain indicators. During bear markets, entities with low propensity to sell hold more coins. In periods of market downturns, such as bear markets, on-chain indicators reveal that entities with a low propensity to sell tend to hold onto their coins. These entities, often characterized as long-term holders or HO dealers, exhibit a strong conviction in the potential long-term value of their holdings. Despite the downward pressure on prices and the prevailing sentiment of uncertainty, these holders maintain their positions, indicating a belief in the underlying fundamentals of the cryptocurrency they hold. Long-term holders are unlikely to sell even in a significant bull run. Conversely, during significant bull runs characterized by surges in cryptocurrency prices, long-term holders remain steadfast in their commitment to their investments. Despite the allure of potential profits and the temptation to capitalize on price spikes, these holders exhibit discipline and patience, refraining from selling their holdings prematurely. Their resilience underscores a strategic approach to investing, anchored in a deep understanding of the intrinsic value of the assets they hold.